Hey, everybody, thanks for joining us. This is a very, very deep and wide presentation, and it will be recorded. So we're going to cover an awful lot of stuff. So don't freak out when I share all of this with you. First thing we're going to start with is a little brain teaser about Bill. How much fun is that? So here's the thing. Bill, he's worked his whole very hard whole adult life. He's 63, finally retires. He is going to more concerts than he ever has before. Bill has $58,688 of taxable income, which includes 37,500 in Social Security benefits for this year. As you can see, his $58,688 is taxable. He puts him in a 22% tax bracket. And because it's more than $50,401 and less than 105 and change, that sets him right up in that bracket, okay? Toward the end of the year, he decides to take an extra $1,000 out of his IRA to go see Willie Nelson play in Austin. How much is he taxed on what on that extra $1,000? So if he's in the 22% tax bracket, one would think it's 22%, right? That's what most people would think. And so we've got a couple polls here to help you guys engage with us. And Becky is going to launch the first poll. It's a little quiz. If you guys would participate, Becky, can you launch that poll for us?
Polls being launched now.
Awesome. Thank you, guys. Beck, can you share the results? There we go. So thanks for the participation. It really does help. You can stop sharing now. Okay, so the answer is over 40%. That's so the extra 1,000 ends up popping him over another bracket. And so the effective tax rate on that extra 1,000 is 40.7%. Same income, same bracket, but completely different outcome. And that gap between what people expect and what actually happens is what creates problem in retirement planning. And that's where we are headed today. So this is the second of 5 polls, and we want to make sure if you guys could just share with us, Beck, if you could launch that for me, what you're trying to accomplish today. This helps us understand where we need to really focus.
Polls launched.
Thank you.
Just a couple more seconds.
Thanks. These are not mandatory, but it does help us understand what most folks are concerned about and why you joined us today. So thanks for the help. Can you share that with us, Beck? Oh boy, I just messed up. Oh, okay. It just popped up in another window. Becky, can you see the results? Because it is a new window. Okay,
No.
so folks are saying obviously retirement planning, IRA income, and how it'll affect taxes. Zally says everything. Tracy, you've got a big day coming in May. Holy cow. And Robert, how to minimize taxes. Okay, so you all get 5 gold stars for that help. Thanks. All right, let's move forward. Okay, so before we get started, I want to introduce ourselves. We are one person down. Poor Chaz is not feeling well today. So Becky is stepping in as Vanna White. Thank you, Beck.
No problem.
You guys know who we are, but we are recording this session. And what's really neat about this is afterwards, we have folks that don't know anything about us. So I'm just going to quickly introduce ourselves. So I'm Kelly Olchak. I'm the managing partner of Lindley and Company. Becky and I own the firm. We are a registered investment advisor based in Bushnell's Basin, which is right outside of Rochester, New York. We work with a handful of families, helping them with their finances and retirement planning. We are fiduciaries, and our responsibility is super simple. We put you and your interests first, even if you're not a client, because that's the way I would want to be treated. I've been a certified financial planner since 2009. And what I love most is helping folks understand this really complex stuff and make it really easy to absorb and help you with confidence in your planning. Chaz is not here, but she is our operations manager. Becky is our chief compliance officer. Very, very few firms our size have a dedicated chief compliance officer. She focuses solely on our back office compliance and making sure that we meet the highest standards and our stuff runs smoothly. So I just want to be clear, and this is for Becky for sure. We're not giving you tax advice, but we are giving you tax planning ideas. And we're going to talk today about how certain decisions can affect your outcome, especially around income and withdrawals from different kinds of accounts. So this high level just explains a little bit about the kinds of accounts you might have. It says traditional IRAs, but you might have a 401k, a 403b, a simple IRA, a SEP. Those dollars have never been taxed before. Roth IRAs have been taxed, and if you use them accordingly, when you withdraw, your distributions are tax free. The other thing to know about is that we're only talking about federal taxes right now, and like Sally's down in North Carolina, and other folks that work with us are not in New York. So we just want to make sure that folks know about that. Let me turn that stupid thing off. Hush. Okay, so let's get going here. What we want to do is shift how you think about retirement planning because the rules change more than most people expect, especially recently. For most of your life, you've been accumulating, right? You're in the accumulate phase. You're working, saving, contributing to your retirement accounts. And as you approach retirement, you move from saving money to now needing money from your accounts. And it's a little weird because folks don't really understand that distribution phase, and it can be more complicated. On top of that, everybody's situation is different. So probably your kids, if you have kids, are no longer dependents. So that tax benefit goes away. Maybe your mortgage is paid off, which sounds great, but that deduction goes away as well. If you are retired already, you may lose benefits like healthcare insurance. And if you're no longer working those, then you lose those big uh, big tax planning tools, it can reduce your opportunity for tax efficiency. Then you'll start taking Social Security, and sooner or later you'll hit an age. Some of us will be 73 when this happens. Sally, for instance, is already in the required minimum distribution phase, but the government does make you take money out of your pre-tax accounts, and the list goes on. Many aspects of retirement will affect your tax bill. So what we're trying to help you do is kind of understand what those might be and give you ideas on minimizing taxes. I strongly believe that my job isn't to help you pay the least amount of taxes this year, but the least amount of taxes over a lifetime. People do pay more taxes in retirement than they expect, which is what this presentation is about. So we're trying to help you avoid as many of those situations as you can. This poll is about what keeps you up at night. Beck, can you, I must call it Chaz. Beck, can you launch that poll, please? Thank you, guys.
Just I be myself.
Go ahead and share that.
Can you still let yourself?
Yeah, this is great. This really does help me understand that we're hitting the mark with these conversations because, people want to make sure that they don't change their lifestyle and they don't run out of money. And of course, healthcare. Thank you, Tracy, for that. Yep, consistent messaging. Thank you. Okay, so we're on the mark. Um, One thing I didn't mention was feel free to add questions in the chat. I want this to be a two-way conversation. So if I hit on something that you want to know more about, let me know, okay? Okay, so if the rules are changing throughout retirement, then our solution has to change too. We need to have strategies that anticipate both traditional taxes and possible taxes, surcharges, penalties that are related to things like Medicare, healthcare, Social Security, and other income sources. That's why tax planning is so important. So my goal today is to walk you through key pieces that of this strategy that'll help actually be actionable for you guys to build a more intentional process. First step is understanding what I'm going to call taxes. And that is a loose term, as you'll see moving forward. I'm talking about anything that increases as your income increases. Some of these are labeled taxes and some of them are not, but economically they function the same way. Once you understand what these are, the next step is to coordinate what that will actually look like in your particular experience, how you can draw different accounts over time, what your retirement spending looks like. And because the order and timing and amount of withdrawal you take, that will directly impact how much you keep. And I like to make it and keep it, by the way. Getting that right will allow you lots of control and give you, when I say control, effectively control your tax rate. And that means deciding where your income comes from, when to take it, instead of just blundering forward. And when we do that, the outcome is simple. You get to keep more and you get to build more wealth. So there are four stages in retirement. Before you retire, we call this the pre-retirement years. This is when you're working and saving, getting ready for retirement. That I call ages, 60 to 70, the go-go years. Um, my favorite thing in the whole world is to help people get to a place where they can actually say, wow, we're retired and we can actually go and have fun. Some people are going to want to travel, they're going to want to volunteer, maybe new hobbies, maybe part-time work in an industry that you wanted to always do, but didn't have time to do it. And of course, spending more time with family. That next part is 70, 80, and things are slowing down a little bit, which brings more financial decisions, such as how to deal with your required minimum distribution from your retirement accounts. And finally, the later years when your health may not be as good, or you are looking to make sure you have a legacy, where are you how are you going to most efficiently pass your legacy on? I have some clients that are saying, I'm not giving my kids anything. I want to spend it all, which is part of the deal. There are things that we have to be conscious of because retirement has many surprises. And even the best planning, like I used to say I don't have a crystal ball. And then Becky got me a crystal ball for Christmas, but it still doesn't work. And even the best plans change. So one of the biggest ones is inflation. People don't really consider this in current dollars. And, think about what a gallon of milk or a gallon of gas cost 30 years ago. That's inflation. The other thing people don't realize is how long they're going to live. I saw this in your responses. I don't want to outlive my money. It is remarkable what our life expectancy is now versus what it was when my grandparents were alive. So, of course, we don't know how long you're going to live, but we try and make sure that we plan for longevity. Janice, you brought up not changing the style and the way you live right now. And so, pre-retirement standards, you, I don't know. I don't think I want my standard of living to drop after I retire. So expenses, cash flow is really, really important. And then there's the 10,000-pound gorilla in the room called healthcare. And costs do increase. I don't think they're going to change. So at this point, you're probably thinking, oh my God, so what's the first thing I need to understand about retirement? So here's the first key. We need to know what your after-tax retirement savings picture looks like before you're retired. So if you had a $500,000 retirement savings, it really isn't $500,000 because when you take money out of your IRA, let's say all your money is in an IRA or a 403B or a simpler, those dollars have never been taxed before. And so we have to consider when you take money out, you're going to be taxed. And there was a law that came out called the Secure Act 2.0, and it changed the ages of when people are now required to take distribution from your IRAs. When my mom and dad were pre-retirees, their retirement age for taking distributions was 70. So a couple years ago, it shifted. So if you're born between 1951 and 1959, now your required distribution is 73. If you were born after 1959, then it's 75. So that gives us some runway to, if you are in those age bands, to do some really neat tax planning. So this is just a quick visual of, what the $500,000 IRA looks like. So in this illustration, we're assuming a boring old average 6% return. And there are different tax rates here, 0 tax rate, 12% tax rate, 33. And what it shows is the value of your IRA in those tax brackets. And remember, this is just an illustration. There's absolutely no way you'll get 6% every year. This is just a way to illustrate it. Okay, so now you're probably thinking, uh-oh, now what? My savings isn't worth as much as I thought it was. So Social Security and Medicare have their own, what I'll call tax traps. And we do need to plan for that. So let's start there. So let's go back to our friend Bill. So he's sitting in the 22% tax bracket, nothing unusual there. Then he takes out that $1,000 out of his IRA to fund the concert. And even though it seems simple, he's now dinged an extra $407. So that $1,000 is taxed more. So what happened? The extra 1,000 didn't just increase his income by $1,000. It affected other areas. Okay. So Social Security can be taxed at 0%, 50%, and 85%. In Bill's situation, that extra $1,000 popped him up into that 85% tax bracket on his Social Security. So when you put it all together, for every dollar Bill takes out, he's now taxed $1.85. And that extra hits him, what we call it is the Social Security tax torpedo. Your tax bracket doesn't always tell you what your real tax rate is in retirement because your income decisions can, where you took that money from, triggered another taxable event. And this is one of the biggest surprises in retirement that I help folks understand, hopefully before that occurs. Okay, so let's zoom out for a second and talk about how people actually approach retirement. Some people will completely retire meaning not work at all, they'll fully retire. Others want to work a per diem. Maybe they want to work at Home Depot or they just don't want to sit at home all the time. And some people want to volunteer. But the key point is if you're earning income in retirement, it can impact your taxes and not always in an obvious way. So let's look at how working during these years can be a good thing. Chances are you guys have researched what your Social Security might look at various ages. That's something we do a lot with our clients. You may not know that your Social Security income, your benefit, is calculated using the highest 35 years of inflation adjusted earnings. So if you guys get your Social Security statement, you'll see a bar chart on the first page. You open up your statement, you're going to see your earnings over a number of years. And you go back to the 70s and 80s, and they will inflate those dollars. So what Social Security does is take your best 35 years. Okay. So if you started working late in life, maybe you stayed home with the kids, you may not have 35 years of earnings history. Suppose you have only 28 years. You've got 7 years of big fat zeros when you calculate your benefits. However, that's good news because if you continue to work, earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates your benefit, replacing several years of zeros with even a modest earning can have a major impact. Now, here's where things get a little tricky. If you start Social Security early and continue to work, there's a limit on how much you can earn before they will reduce your benefit. So in 2026, let's say you retired at 62 and turned your Social Security on. Like I've got a teacher that just did this. So she's 62 and she's getting her benefit and she's working part-time at school. She actually told her employer, I can't earn any more than $24,480 this year. And because of that, she will not be penalized. But if she earned more than that, for every $2 you earn, they'll take $1 away. Don't freak out. If you guys are doing this or considering it, we can work through this because that benefit is not lost forever. So what they do is they might pull it back, but when you hit full retirement age, they adjust that. So you will get those dollars back. Any questions so far? Okay. So let's talk about what I call the ugly, because this is where taxes start to show up in many ways that people don't expect. And again, we're talking about taxes and retirement. So if you're working in retirement and you're still paying Social Security and Medicare taxes, just like you did when you're working, you're going to be taxed at 7.65% if you are not self-employed and twice that if you are self-employed. Now, these taxes don't go away if you're working past your full retirement age, even if you're collecting Social Security. Here's the kicker. Those taxes don't always benefit you. If your new earnings don't fall into that top 35 years, you're paying into a system without increasing your Social Security benefit. So what that means is if you took your Social Security at full retirement age and you're still working, you could be increasing that best 35 years. But if you're working part-time, you're not. So working in retirement isn't good or bad. It just changes the equations. Okay. This is a multiple choice one. So Beck, will you launch that poll, please? Beck, why don't you share those? That's awesome that you guys knew that. Thank you very much. Okay, let's move forward. So we're going to start talking about Medicare and taxes. So there's this thing called IRMA, IRMAA, and that stands for Income Related Monthly Adjusted Amount. And the emphasis is on income because it's your monthly tiered surcharge. Again, it's kind of a tax, but it does add up. And it's tacked on to your Medicare Part B, which is doctors and outpatient stuff, and then Part D, which is your prescriptions. But it only happens if you have income over $109,000 for a single filer or $218,000 for married filing jointly. So let's take a look at this and see how it works in a scenario. So this is George and Martha. They're high earners. They file jointly and both have Part B and Part D Medicare. IRMA surcharges affect income for 2 prior years. So what Medicare does is it says, what did you earn 2 years ago? So we can calculate what this year's Medicare costs will. And so they had $342,000 of gross income in 2024. Not too shabby. However, on December 1st, 2024, George decided to sell a stock that he bought in 2007. He bought it for $10,000. He sold the stock for $11,000, which resulted in a long-term capital gain of $1,000. And the $1,000, those gains were taxed at 15%. But because they earned a certain amount of income, they were also taxed 3.8%, and that's called net investment income surtax. This again applies to folks that single people, if they are filing as single, $200,000 of income or more. For married, filing jointly, $250,000. So George and Mary owe $188,000, sorry, $188 of taxes on the long-term capital gain. And it affected their health care. So their premiums went up. So once that income crossed that threshold, their premiums jump, sometimes a lot. And it's not Part B, it's also Part D. So, and it's per person. So George and Martha will pay another $22.90 a month for their drug plan, which is an extra $549.60 for that year. But when you add it up, they're paying like $3,400. So this is another part where I say, don't freak out. We can sit down and talk about this and explain it. We're just trying to educate you guys. So here's how it broke down. So they had an extra $1,000 of income because of the capital gain, which was taxed at 18.8%. That stock sale crossed them over the IRMA income tier. Isn't this a fun presentation, you guys? I'm such a little ray of light. Okay, so any questions? Okay. Timing matters more than people realize, especially when it comes to income, Medicare. If you get your timing wrong, it's not just a small mistake, it could be a lifetime penalty. So this couple, Jim and Ann, they're both 68. Jim retired at 65, and he was covered by Ann's insurance at work. She retired a year later, and her employer offered a retiree benefit for health care. However, they forgot to enroll in Part B, even though she was covered by her employer benefit. And here's where things went off track. They assumed that because the retiree health coverage, they had that retiree health coverage, they didn't need to enroll in Medicare Part B right away. But once you retire, no matter if you have an employer plan or not, you have to enroll in Medicare Part B. And because they delayed, they missed a window, and now this ripples forever. So it triggered an increase in Part B premiums for 10% every year. So that's an extra $487. And that happens and follows them every year. So we really need to pay attention to coverage gap. When I started, oh, and okay, so Tracy, thank you. Yes, it's only if they are over 65. So when you hit 65, you have 3 months before you turn 65. I'm sorry, Trace. You have 3 months before you're 65 and 3 months after. And we've got really nice handouts that we can share with you to help you figure out your timing. Yeah. When I started working on this presentation, I thought, oh, this is going to be a bucket of laughs. Okay, so at this point, a lot of people are probably thinking, holy cow, what else is out there? Um, what we've talked about is Social Security, tax torpedo, and the IRMA thing. What we're going to talk right now about is things that are hiding in plain sight. This is where your distribution matters, income, retirement income distribution strategies. You really need to understand which accounts you should take income from at which time to minimize those extra taxes. So here is an example of a couple, and they have lots of different buckets. So the IRA buckets for Sam and Mary, those IRA buckets, those dollars have never been taxed. Then you've got these Roth buckets, those dollars have been taxed. So the IRA buckets, when those dollars come out, 100% of the distribution is taxable. The Roth buckets, all of the distributions are tax-free if you're over 59 and a half. And then they have a joint banking account of $300,000. So the question really is, where do you take money from first? Most people, even a lot of large investment firms, follow a simple rule. They call it conventional wisdom, and everybody's ride is different. And of course, I am still not giving tax advice. I'm just giving you some ideas that might be good questions for your tax professional. So conventional wisdom states spend money that's in your bank account first, and then your IRAs, and save your Roth for later. It sounds logical, but it doesn't always mean that's optimal. Okay, so, and just remember, this presentation is being recorded, so you can definitely come back to it. But there is real research around income distribution in retirement. So you will get these slides and can dig in. But what really helps us as planners is understanding a coordinated strategy. And we work with your tax preparer to make decisions on where to start. So we're not flying blind. So here is an alternative approach. There are two key elements in the early years. First, use your taxable bank accounts for expenses. However, I do have clients that really, really, really love to see their savings account stay consistent. It's just a way people are. But also during the same period, you might decide to accelerate. Let's say you're not taking Social Security yet. Accelerate your IRA distributions during that low income period, putting that money into a Roth account. And that is called a Roth conversion, which we're going to touch on here in a minute. Does it make a big difference? I am convinced it does. And the research that we just looked at backs this up. But the biggest takeaway here is, of course, you have to have a plan and you have to understand where your dollars are coming from. So let's talk about Roth conversions. We're doing this a lot lately. And one of the biggest reasons we're doing it a lot lately is because the Secure 2.0 Act pushed RMD, required minimum distribution ages, back from that 70 and a half to 73 or 75. So we've got a longer runway where they're going to make you take money out, okay? Okay, so all you're doing when you do a Roth conversion is you are taking it out of your IRA, paying the taxes off, and then putting it right into the Roth IRA. Of course, there's a trade-off because you are increasing your taxable income. And we just talked about IRMA and Social Security taxes. So we have a really good way to model this with your CPA so that you can see what's the amount. We have a way of showing how much can I take out of my IRA without getting me in that IRMA phase, okay? So basically, this is filling the buckets. right? So in retirement, you might be in the 12% tax bracket. And so we convert dollars from your IRA to fill the 22% tax bracket and really work hard to not hit that IRMA penalty area. And this is a multi-year strategy. It's not a one big chunk. It's like little slices over the years. And again, this might not work for everybody. Again, it's just an idea. So if you're a business owner, which no one on this call is a business owner, but there are other things that business owners could leverage if they wanted to do this sort of thing. And again, it's not an all or nothing strategy. It's what fits for us right now. Again, that crystal ball of mine doesn't work, but it will allow you to have a strategy that can be changed as time goes on. So sometimes people have, and actually my mom and dad are going through this right now. My mom and dad in 1966, they got whole life policies for themselves when they got married and had me. And they have a lot of cash built up in those policies. And the reason they bought that insurance is not why they have it now. And so by taking money, the cash out of the policy, that could be a tax-free event. Again, we would talk to your tax professional on that one. The other thing is if you're in a low income year, going back to the illustration where I think his name was George, sold $1,000, sold $11,000 in stock and had $1,000 gain. Sometimes your capital gains are zero because you're in a very low tax bracket. So timing that kind of sale could be zero taxable event, which I like zero taxable event. And again, going back to what I said earlier, in a lower year, let's say you're not going to take and do a Roth conversion, but you have a low income year, you might take more out of your IRA and put it into your savings account because your tax bracket's low on that year. Okay, so now we're going to talk about something really, really important. And this just came up in our practice a couple of weeks ago. So the first part involves your health savings accounts, your HSAs. And this applies if you have a health insurance policy that is a high deductible plan. You can contribute, I think it's up to $7,000 a year into your HSA, and that will help you with qualified expenses while you're in retirement. So for the right people, using the HSAs to pay for expenses like medical expenses. The example we had was a client who had got laid off and he has an HSA and he's not 62 yet, but he had 62,000, 61,000 and change in his HSA. And we looked at helping him find a health insurance policy on the Affordable Care Act marketplace. And what we learned was, so he had a choice of getting his own insurance or using COBRA from work. And what we learned was, and this is something new, we thought initially that he could use his HSA to pay his marketplace insurance premiums. He could not, but without a taxable event, but he could use it to pay for his COBRA premiums for 18 months. Big difference because that got him to 65. Pretty cool. This strategy is for business owners, and I don't see anybody on the uh, webinar that are business owners, but there are ways to leverage some qualified business income deductions if you were. Okay, but going back to the HSA, I probably should have flipped the slides a little bit. The second thing we learned about HSA, we have a client who is retiring in June, and she was making contributions into her HSA every month. And she had started getting enrolled in Medicare, and she did not realize that she should have stopped making contributions. So once you are enrolled in Medicare, you're no longer eligible to contribute to that HSA. And this is what catches people off because Medicare can be retroactive for 6 months, and that's where she got dinged. Now she caught it in January, so it was only like $400, and her employer was able to unwind it, but it was something that we didn't even consider. So that means if you keep contributing during that 6 month window, it can become what's considered an excess contribution, and it can trigger penalties. So stop your HSA contributions 6 months before your Medicare begins, not after. Any questions? We're doing pretty good. There are 106 slides in this puppy, and I was like, oh my God, how am I going to get all this done? But we are on track. So now we're going to talk about other ways that you can reduce your taxable income. And we are going to talk about qualified charitable deductions. And here we go. So here's a simple example. So Albert and Shirley, they're in the 24% tax bracket. They have about $15,000 in itemized deductions, and their standard deduction is about $32,200. So they use the standard deduction. They decide to give $5,000 to a charity, but even after that gift, they're still below the standard deduction. So that charitable contribution did not affect their taxes. They got no tax benefit. Now, there's another way. So let's say that these folks were over 70 and a half and they have an IRA. They can make a qualified charitable deduction or QCD right from their IRA. And it helps satisfy their RMD. So this is how some folks have done it and don't realize that they left money on the table. So they wrote a check and paid for the charitable contribution. The charity got the money. They did not get a taxable advantage on that. So the real cost to them was $5,720. They still paid. So they took money out of their IRA, put it in their checking account, and wrote a check from their checking account to the charity. No taxable benefit at all. Now, if they had done it in this way, it would have created a benefit. Instead of writing the check out of their checkbook, we would send the charity a check directly from their IRA payable to the charity, and it goes to the charity and it reduces the amount they have to take out of their RMD. I know this is a little confusing, but by so at Schwab, we custody our assets at Schwab. Schwab would, let's say you wanted to benefit Lollipop Farm. So Schwab will cut the check payable to Lollipop Farm. They would mail it to you, and then you would give it to Lollipop Farm. When you do your taxes the next year, your tax preparer will see that that occurred, and so will the IRS. So you satisfied your required minimum distribution and you reduced your taxes. Okay, last poll. Can you launch the poll back? Thanks. And I just see that I duplicated one of the answers. Sorry about that. That poll is totally screwed up. I'm so sorry. Well, at least you know Kelly's human. Okay, so we're going to talk about ways to help you with your legacy. Organizing your assets in a way that benefits your family is really important if that's what you want to do. Like I said earlier, I've got clients who are like, the kids aren't getting anything. We're going to go live it up. But even though estate taxes aren't an issue for people, most people today, tax planning will play a big role in how your beneficiaries, how much they keep. So here's an example. Let's look at this. Phil and Mary, they have a joint account with $120,000 in unrealized capital gains. And this is where the concept of step up basis really matters. In simple terms, what happens is, so Phil and Mary own a joint account of $120,000 in capital gains, and they own it together. And when someone passes away, there's a reset. That's what the step up basis. In this case, because Mary and Phil own it together, um, some of the benefit would be eliminated. Now, we're talking about all the states in the union that are not community states. And no one on this call right now is from these states, but community states are California, Texas, Arizona, Washington, and Nevada. And also, just so you know, I am not giving legal advice either. I'm just giving you ideas. Okay. So in this case, Phil and Mary hold these assets together, as I mentioned. Phil's health declines, and they begin thinking about seriously how to transfer assets. In the first scenario, they don't do anything, and Phil passes away, and Mary gets half of the step up. So $60,000 of the investment gets stepped up. What that means is a step up means you the capital gains are gone for that person, meaning it's just like you bought it on the day the person died. In this case, only half of the investment was stepped up. However, if, oh, I forgot that there's the math. There's the math. Now, if they had done it a different way, meaning they had the joint account, they signed all of this over to Phil only, then when he passed away, Mary would have zero taxes. This is very important, okay? Because in this situation, she would have $120,000 of investments that she didn't have to worry about paying taxes on without triggering a penalty. Okay, now let's talk about kids. So in this scenario, we're talking about a parent passing on retirement savings to a kid, and that happens all the time. What changed with the Secure Act 2.0 is that the beneficiary has 10 years to take all the money out of the IRA. It used to be stretched across the kid's life, and so or the beneficiary's life, but now that has changed. So if you had passed away after 2020, now your beneficiaries have 10 years for distribution. And taxes are accelerated if you don't have the right planning. So this is scenario one. And in this scenario, Kyle decides to take 10 slices, which creates, about $54,000 in additional income each year. It's predictable. He's still paying taxes, but he's controlling how much and when those taxes hit. Then there's 1.5. And in this slide deck, had a one scenario one and scenario two, and then it dawned on me there's another step. So we have another client who inherited money from her dad, and she's going to retire in 2 years. So she did not take any distributions for the first 2 years. It still has to be out in 10 years, but because her income is going to drop considerably in 2 years, she will then take 8 slices. So she's able to, yeah, she has to take a larger amount, but her taxable event is lower because she's not making $200,000 a year. So timing still matters. The other scenario is you wait till the end. And in this scenario, assuming a 6% average return, that $400,000 balance grows to 716, which is still good, but he has to pay a lot of taxes. Much higher tax bracket. Okay, we are almost done, and I'm sure your head is hurting. I am going to be available for anybody that wants to talk about this. And when I created the slide, I'm like, I would feel the same way. Like, how am we going to put it together? Don't freak out. There's a process that we have. Okay, so let's just take a quick step back. We talked about retirement isn't just one phase. Each stage has different tax considerations. Tax planning is key. So if we go back to the original problem, people pay more than they expect. The solution is actually pretty straightforward. You just need a strategy. One that considers when and how you draw money, the different types of accounts that you have to take money from, the different types of taxes and surcharges you might face. And being proactive is so key. Distribution phase is one of the hardest phases I've seen in my 21 years because we spend all this time saving money and then, oh my God, now you have to take money out. Feels very unnatural. And then how do you get started? So being mindful, it's one of the reasons I like this presentation so much. It just sets the table for really great conversations. Now, any of you, even if you don't work with me, I will be very happy to help you understand any parts of this. A one-on-one would be great. There's no obligation. The goal is to help you with clarity. And after the webinar, I can't believe we did this in an hour. After the webinar, you're going to get these helpful handouts, kind of to set the table, right? Understanding that IRMA surcharge, understanding how to and where to take income from. There are two types of tax return reviews here, one for folks that are not retired yet and ones that are. I really do like these because it does sort of get your mind thinking. And that's the end of it, folks. Any questions at all? I'm so grateful that you joined us. I know that this is a lot of information. Awesome. And this is Becky's favorite slide, E-I-E-I-O. Thank you so much for joining us. Trace, I know. We'll talk next week. Don't, you guys, this is so much information. And like I said, once we're done here, I'm going to set the replay and I'll email you the replay. Nancy, I know you were a little delayed. Don't worry. You're going to get a copy of the whole thing. And as always, I love hearing questions and feedback. There is a survey after this. Please help me with that. I want to make sure that we're not missing anything, what we could do better. And thank you very much. We did it in under an hour back.
Yeah. Thanks, everyone.
Thank you, guys. Be safe. Thanks, Nancy.